they talked about the valuation role of accounting information. Specifically, Professor Mark Greenblatt talked about the use of accounting numbers to try to identify mispriced stocks. And Professor Shivaram Rajgopal talked about how to do more detailed analysis into accounting numbers to try to come up with better valuation of companies. So essentially, this is what is called the accounting role of the valuation role of accounting information.
Jeff, can you turn on your mic, please?
Okay, so there is also the contracting role of accounting information. Okay, so under the contracting role of accounting information, essentially you can think of contracts containing accounting numbers. For example, compensation contracts containing ROA targets, ROE targets, so that managers can get bonuses. Okay, you can also think of accounting numbers being used in loan contracts to make sure that the borrowers fulfill their obligations. Finally, there's the monitoring role of accounting information. And my research tends to focus more on the monitoring role of accounting information. So basically what I study is how accounting information can be used to monitor problems, okay? Monitor and deter problems in companies, okay? So you can think of it like accounting having the effect of a CCTV system. Okay, now I'm going to give a brief introduction of accounting systems of banks before I talk about a specific research that I do. So basically, under the accounting systems of banks, banks are supposed to record loan loss provisions. And these loan loss provisions are essentially losses in anticipation of future bad loans. So what happens is that when banks think that they are going to have bad loans in the future, they actually record losses today as opposed to in the future. And these losses will affect the profit and loss statement. So what this basically means is that banks will start showing the losses today. Then what happens is that these loan loss provisions are added into what is called the loan loss reserves, which is a balance sheet account. And when the loans actually turn bad in the future, okay, the amounts are taken out of these loan loss reserves as loan charge-offs. So why is this an interesting area of research? Like what I mentioned earlier on, okay, when banks expect loan losses in the future, they have to record the losses today. So what this means is that when banks record the losses today, the earnings number will be lower, and they will also have lower regulatory capital ratios. And so this could affect decision-making by banks. The area of research that I focus more on is this area known as loan loss recognition timeliness. Now, when banks record their loan losses, there is some discretion to the amount of loan losses they record today. Do they want to record more or less? And the decision to record more or less loan losses could be driven by incentives, could be driven by regulators, so on and so forth. So loan loss recognition timeliness essentially measures the extent of the timeliness of recording loan losses today in anticipation for future loan losses. And this is an important issue in the banking because if banks are not timely in recording loan losses, they might end up making bad decisions, okay? So, recently I published a paper in the Journal of Accounting and Economics, and in this paper, we study the monitoring effect of loan loss recognition timeliness. Essentially, what we find in the paper is that when banks are more timely in recording their loan losses, what is going to happen is that banks will end up making better decisions. For example, there would be less problematic loans. Bank officers are more careful in terms of taking bribes when giving loans. Because what happens is that these loans tend to be bad loans. These loans tend not to be repaid. And when the accounting system results in loan losses being recorded earlier, what's going to happen is that these numbers will appear at an earlier stage, and it gives less time for bank officers to benefit from making bad decisions in general, okay? Now, we also find that this monitoring effect of more timely loan loss recognition timeliness to be greater when society in general care about the loan losses of banks. So what do I mean by society in general? You can think of depositors. As you are aware, depositors are the main contributors of funds for most banks. So when depositors care about the loan losses of the banks, they might care about the loan losses of the banks because they are concerned that their deposits will not be repaid. So when they care, then the CCTV effect arising from more timely loan loss recognition would be greater. Another example of what I mean by when society cares is when there is less state ownership in the banks. There is this general idea that when banks are owned by states, loan losses are less important because even when banks perform poorly due to the loan losses, there will be bailouts from the government. Okay, so in other words, what we also find is that the CCTV effect of more timely loan loss recognition is greater for non-state-owned banks. So, how does this kind of research contribute to society? In general, our paper contributes to policy making. Okay? So by documenting that more timely loan loss recognition can help to reduce banking problems, the policy implication is that regulators should try ways and means to encourage more timely loan loss recognition. Okay? And what I'm saying is actually taking place right now. And I'll give you a brief explanation why. Okay? So in the last financial crisis that basically started in the United States, many banks were accused of not making timely loan loss recognition. So basically, they were delaying their loan losses until a later time, until the financial crisis happened. And so, when the financial crisis actually hit in around 2008, 2009, many banks had to record a lot of loan losses that they should have recorded much earlier. So in view of this problem, regulators have been figuring out ways to ensure that loan loss recognition is more timely. And recently, there has been some accounting standards that have been developed to encourage more timely loan loss recognition. For example, there is this International Financial Reporting Standards number 9 that now requires banks to use the expected loan loss model to record loan losses as opposed to the incurred loan loss model. Now, I might be speaking something really abstract, right? But essentially, this accounting standard now requires banks to be more timely in terms of loan loss recognition. They need to incorporate expectations of future conditions, including macroeconomic conditions when making loan losses. Simply stated, when the bank expects there to be, let's say, a recession in the future, then they should record more loan losses today because borrowers are expected to be less likely to be able to repay their loans. Okay? Now, so this is what is happening with International Financial Reporting Standards. And this International Financial Reporting Standard took effect this year. In the United States, there is a similar standard that requires this new model of accounting, and this US standard will become effective next year, okay, in 2019. So you can see, right, the issue of timely loan loss recognition is a very important issue because, as we have documented in this paper, it can affect the decision-making of banks and their officers. Now, so just to conclude my presentation, okay, what we basically document in this paper is that the accounting system does not just, let's say, for example, provide information for valuation purposes. It provides accounting numbers that can be used in contracting. It also has a monitoring, or what I call the CCTV effect. It monitors the actions of relevant people to ensure that the relevant people perhaps make better decisions for the organizations that they work for. Okay? And so I hope that after my brief presentation here, you will understand accounting exists for a good reason, and accounting professors exist for an even better reason. Thank you very much.